Hello everyone, welcome to Keerthi's FinFo NRI community. I'm CS Keerthana, I live in Dubai. I run the consultancy, a firm which is specialized in NRI services. I'm a CS from India and CIMA strategic level from UK. I'm also a semi-registered overseas MFT. Every week I bring and explain a video in this channel on various topics related to NRI issues. If you're looking for finance, FEMA, tax and investment topics related to NRIs, please subscribe this channel. NRIs, the due date is July 31st. Yes, tax filing season has started. This is the time when many of us have doubts regarding whether filing of returns is necessary, whether it is applicable to us, what is my residential status, etc. So I have decided to make a video on tax returns and its related issues. In this video, I am going to explain when NRI should file tax return. Is it compulsory for him? What are the triggering points? Second, how to file ITR. In the last part, I'm going to discuss how you can file revised or delayed return, etc. First thing first, if you want to know who is NRI, I made a detailed video here. Please use this link and watch the video because it is important for you to assess your residential status as NRI or confirm whether you are NRI because the tax status has to be determined every year. When you watch this, you will understand the various criteria or circumstances which makes one an NRI or resident. Actually, there is no one particular definition for non-resident Indian. So how do we interpret who is not resident is NRI? So please take some time out and watch this video fully to understand the residential status. Now let's delve deeper into the tax returns. First, generally, as an NRI, the foreign income is outside taxation. No confusion here. So, the foreign or global income is outside the scope of taxation unless you become an Indian resident. As NRI, you are not going to be taxed on your foreign income, but there are certain income sources in India and also a threshold limit which acts as a triggering point. What are they? Let's categorize it as income criteria, expense criteria, as well as some deposit related criteria and other miscellaneous one also. So these are the criteria. Upon touching this, it becomes compulsory even for NRI to file a tax return. Let me make it very clear once again. When I am referring to income, that is strictly in the context of income generated from Indian sources. So let me break it down for you so that it becomes crystal clear for you to understand what are these different income sources which are going to constitute our final total figure of taxable income. See, it may be salary. I know you are thinking, how come if I am employed outside India, it's going to be salary? It's possible. If you have rendered any services to India, or you might be on some short assignment deputation to serve clients of your employer, though he is outside India, but the client base is in India, then you must be taking care. And second one is rental income. Next is business income from India. That is where you have a business set up in India. You may be controlling it even sitting outside India. Doesn't matter as long as it is a business income generated within India, it's taxable. It may be interest income also from the deposits. Deposits again here which are not tax exempted such as NRI or FCNR. I'm specifically focusing on taxable interest income which is from your NRO account and capital gain from mutual fund, share, real estate or any other sale of the capital assets. So this does not include foreign income. However, as I said earlier, if you end up falling into the resident category, then even the foreign income is going to be taxed. In nutshell, I just want to tell you, if your stay in India exceeds certain number of the days, for whatever the reason it is, you may fall into the category of being resident. Then the income gets taxed in India as well as the country of your residence or the foreign country. Then what happens in this scenario? DTAA comes in. Double taxation avoidance agreements are usually signed between India and many of the countries. So here this gives some kind of relief. It may be exemption, reduction in the rate, or even allowing the tax paid in one country to carry forward that as tax credit in another country. So to summarize, this double taxation avoidance agreement gives relief by allowing the tax credit of the tax paid in one country. So it's not so straightforward or simple process. Please seek professional help if you are resident of India as well as another foreign country, because it requires careful, detailed study of the relevant double taxation avoidance agreement. Our firm, The Consultancy, can help you in filing the tax returns or DTA related issues. We have assisted many NRIs so far in DTAA's tax advisory as well as filing of returns. If you want to avail our services, just go to website www.keerthisfinfo.com or click the link which is given in the description below. Now let's go back to the topic and let's take up income criteria, which I have mentioned earlier. See, in old regime, the basic exemption limit below which it's not going to be taxed is 2.5 lakhs, and in the new regime, if you are opting for it, then it is 3 lakhs per annum. If Indian sourced income or the income which you are generating using Indian sources had exceeded this basic exemption level, then it becomes mandatory to file income tax return in India. That means below this point, it is completely your choice to file or not to file. I will make one more detailed video on the benefits of filing ITR. There is one more point which I want to emphasize. If you are choosing new regime, that means income before considering certain deductions, such as maybe the premium towards your LIC or ELSS schemes investment under 80C or donations under section 80G or medical under section 80D, all these things you have to consider. So it is income before the deductions allowed under these sections. I hope income criteria is clear. The moment when Indian sourced income is exceeding 2.5 lakhs in the old regime or 3 lakhs in new regime, it kicks in. Then what is our second point? These are expenses or deposit related criteria. So they are going to track the deposits that you are making as well as the expenses that you are incurring. You may not have that income criteria applicable at all, but still if at all you're falling in this category, then filing of ITR is compulsory. So the expenses are electricity bill. If at all you had incurred electricity bill expenses exceeding 1 lakh rupees per annum, or if you had deposited amount exceeding 1 crore Indian rupees in Indian bank in your current account. Please note, this is not your SB account, this is current account, that too in Indian bank. So don't include your NRE, NRO account deposits here. And in your SB account or saving banks account, the amount deposited has exceeded 50 lakhs rupees. Or you had TDS or TCS, tax deducted at source, or tax collected at source exceeding 25,000 rupees. The next point is little interesting. If you had incurred more than 2 lakhs rupees on travel expense from India to any foreign country. So remember, if you are NRI, please don't plan your foreign trips from India. Even if you pay for someone else's travel from your Indian bank account, then this gets triggered. Now, there are other miscellaneous points also which you have to bear in your mind, which makes you to file ITR mandatory. So they are, if NRI has long or short-term capital gain. That means if you have sold your mutual funds or shares or any capital assets and you have capital gain, you have to file. If the turnover or the sales of the business set up in India is more than 60 lakhs rupees. So if you have any business in India, wherever you are sitting and controlling, it doesn't matter, the turnover is exceeding 60 lakhs, file income tax return. And in case if you are a professional and practicing any profession, this turnover is just 10 lakhs, filing of return gets triggered. I hope now you got a complete picture of when filing of return is compulsory. If you are thinking, what is the income which will be taxed, or what is the definition of this taxable income? Let me explain that also. Taxable income for the purpose of filing returns means before considering the deductions. I have already mentioned it. In case of NRIs, what are the sections? This 80C, 80G. So before deductions you have to consider. Also remember, this also includes the exemptions. Certain exemptions related to reinvestment of capital gain. They are also not to be included. For example, you may be selling a property and earned a capital gain of 1 crore rupees, and you may be planning to avail that 50 lakhs tax exemption by reinvesting in qualifying bonds. Up to 50 lakhs you can get capital gain exemption. So here the declared income or taxable income is not 50 lakhs. Complete 1 crore you have to show. One more point I wanted to remember is, if at all your income is exceeding 50 lakhs Indian rupees, then you must also disclose all your movable, immovable assets and liabilities. So you have to prepare assets and liabilities and submit in India. Now let's go to our second point, how to file tax return. This is not so complicated like the first part. You just have to follow these simple steps. First one, ascertain your tax status as an NRI. I have already given you a video link. Just go through that and understand whether you are NRI or resident. Now if you are NRI, choose the form. Other than business income, for all the income sources, it is ITR 2 which is used. In case of business income, ITR 3 is supposed to be used. Go to the tax portal, fill all the details of your income, deductions, etc. Section 80C, Section 80D, Section 80G, these are available for NRIs to claim deduction. So using these deductions, what you do? You are reducing the taxable income. Once you arrive at taxable income, then just apply the applicable individual tax slab and determine your tax liability. You get all information on TDS in Form 26 years. Use this to reconcile your taxes and income. Next, provide bank information so that you get refund if it is applicable. The last point, use EVC or electronic verification code or Aadhaar OTP to verify. Even you can use net banking also and submit. The last part, as I said, I want to explain the due dates, delay in the return filing, revised return filing, as well as updated return filing, because many times there is some commission of error or omission of the facts also which has to be disclosed, and you realize after filing the return that, oh my god, I've done a mistake here. What to do? How to rectify? So you should know what are the options that are available. So for the financial year ending on 31st March 2024, the due date is July 31st, 2024. Now the extended due date is 31st December 24. So that's just another extra 5 months. Once this timeline is also over, in case of updated return, it's 2 years or 24 months from the end of relevant assessment year. Our assessment year is March 2025. So you have time till March 2027. If you miss this too, then you must file for something called condonation of delay. That means with the income tax department, you're going to explain why you did not file within the specified period, what are the reasons. You will convince them, and if at all you want to undergo this headache, I'm sure you don't want that, then there will be an order issued by the income tax department mentioning the date within which you can file. So this provision existing, actually nobody wants to undergo this procedure, but you should know that there is a provision existing which one can apply for condonation of delay up to 6 years from the end of relevant assessment years. That's all. Let's deal with the last point. If you had discovered any kind of error that you want to rectify, then you may file revised tax return, and this can be filed within 3 months prior to the end of assessment year. So our assessment year is March 2025. So 3 months prior is 31st December 2024. Now from financial year 2019 to 2020, we also are permitted, we can do file updated return in case we forgot to mention additional income source and we want to update the return upon paying some additional taxes. It's actually a voluntary disclosure to avoid any kind of hefty penalty where you are disclosing before tax department discovers. So you don't want them to impose penalty. You yourself come forward and you say that, sir, this is the income which I am supposed to declare. But if you are just showing the loss to reduce the tax liability, then you cannot file this updated tax return. Only for additional disclosure of income it is permissible. So not to reduce the tax liability, it's possible to file. Such updated return also can be filed within 2 years from the end of relevant assessment year, that is, as I'm saying, 2025 March for us. So the timeline is 2027 March to file this kind of updated return. This I really don't want you to exercise. This is just to create an awareness that this kind of options exist. The best thing to do is assess your residential status. In case you want to file tax return or you are required to file tax return, please do it before July 31st, 2024 to avoid any kind of further complications. And as I said earlier, in case if you need assistance, we are more than happy to help you. Just log into our website www.keerthisinfo.com or click the link in bio. Our team will get in touch with you. I'll see you with an interesting topic next week. Till then, bye-bye.